Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, August 23, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And after a gap down this morning, it was a pretty narrow-ranging day. We had the big up day yesterday, and today we had a relatively quiet day after the opening. And so that's more common than not after the type of day we had yesterday. Now, into the end of the week, here's what's important. There is what I'll call a volatility cycle that is essentially due to hit Thursday and Friday, or Thursday or Friday. It could be both days. It could be one or the other. My point is that my expectation for Thursday and Friday is that the market is going to move in one direction or the other. When I say volatility cycle, I'm not just saying down. It could be in either direction. Now, we have, I believe, Mario Draghi over in Europe is giving some kind of a speech or announcement tomorrow morning. That comes, generally speaking, somewhere around 8:30, maybe it's slightly after that. That can move markets for sure. The European markets are open at that time, and that can certainly have an impact on our futures market and the opening at 9:30. So that's item number one. The other thing is, whether it's on the upside or the downside, we do have overhead resistance. Now, remember we discussed last night, and we talked at length over the last few days about markets like to retest the breakdown candles or the top of breakdown candles. So once again, we have the top of the breakdown candle from the other day at 246.60. That's an important level. If the market doesn't go straight down tomorrow, which I don't know that it will or it won't, but if it doesn't go straight down and it actually starts to head up, I would look for signs that the market is heading toward the 246.60 area, which also coincides with the downsloping trend line that I put in here yesterday. I just want to go over to the hourly chart for a minute, and we'll talk a little bit about what this could be. And here's the reason why I'm a little bit conflicted in where we are. We're in the middle of a range. So let's start there. So we have this top and this bottom. So we're basically in the middle of a range. So what did we do? We retraced a portion of the move so far. I'm just going to do a rough number. I'm not going to put it on the penny. But you can see here that we retraced 6.18% of the move from the recent top, which also coincides with the downsloping trend line, to the recent bottom. That's generally an important number. Now, the question is this, let me get rid of the fibs for a second, is this a bearish pattern or is it a bullish pattern? And what I mean by that is this a down move and is it making sideways consolidation, getting ready for another down move? That's 100% possible. However, this could also be just a pullback and the market may want to go higher for more of a retracement up into that 246.60 area or the downsloping trend line, I should say, and or the downsloping trend line. So that's why I'm a little conflicted, because I can really see the market both ways. Make no mistake about it, we're in a tricky point in time. Now, the big picture is that we should be in a corrective state. We should have a pivot top in place, and the market should certainly trend lower between now and, let's say, the end of October into the middle of November. That doesn't mean we're not going to have up days. That doesn't mean we're not going to have up weeks. We know that we're going to see both or big swings in both directions, and that's why I'm being relatively cautious where we are right now in the middle of this range. Really, the way I'm looking at it, the market could trade in either direction Thursday and or Friday. I wish it was more clear. It's just not. So we have the SPDR, or the S&P, was down a little less than 0.5%. Going back to the daily chart for a second, take a look at the volume. And the volume today comes in right around 50 million shares. Not a lot of volume. Still indicates that we're in the midst of the summer doldrums. This is not uncommon for markets in August to trade light volume. Obviously, we've had some heavy days, but that's as the market has begun to change character. Bigger picture, it's bearish. However, that doesn't mean we can't have another up day or two. Now, when I look over at the IWM, what we see here is the IWM was pardon me. It was down less than the spider was down today. I'm not saying that's bullish, but it's certainly not necessarily bearish leading into tomorrow. So there's some conflicting data. The conflicting data will come together when we look at the next market in a second. But all in all, this is certainly not a bullish chart. This is a bearish chart. We're below the 200-period moving average. This is making a bearish pattern. So it's telling us that there's more downside coming. It's just a matter of if we go higher first. There is a lot of overhead resistance higher, so we can go higher, but it doesn't change the bigger picture. My conflicting information is really in the near term. Nothing more, nothing less. Nothing's really changed in the IWM from yesterday to today. It was down 40 cents, not a big deal one way or the other. It's not really giving us an indication of any kind of ensuing move in either direction. So there's not a lot we can gain from today's activity. We'll take a look at the NQ, which is the NASDAQ futures market, and it looks very much similar to the spider. We have a big down move. We may want to challenge the top of the breakdown candle here. We had two of those. So the market's going back and forth in the NQ or the NASDAQ, but there certainly is room for a little more upside. We did find some overhead resistance yesterday and today at the 20-period moving average. That tells you that there is resistance in this market. However, and we've done this before, we've seen this many times before. If the market's going to go higher and there is overhead resistance, for example, in the NQ, at the 20-period moving average, it wouldn't be uncommon for the market to jump over that level. If it did jump over that level, naturally it would find resistance at the top of the red candle, which comes in at 59.23. But it's really not that far away. And if we jump over by chance, and I'm not saying we will, I'm just saying this is how we read certain things that happen, and I want to give you a heads up for what if it does happen. If the market, if the NASDAQ, for example, jumps over the 20-period moving average on a gap higher in the market, I would expect the top of the red candle that we just discussed to provide less resistance than it would otherwise provide if it just grinded higher. So it's just something to be aware of. If we're going to see a jump over the 20, my expectation would be that it would be a more strong market than not, and we would probably see some more upside in the cards. Let's take a look at the transports, and here's some of that conflicting information. The transports, certainly one of the canaries in the coal mine. We know that on the downside was leading the market down just as the IWM was. So the transports and the IWM really led the entire market on the first leg down. But look where we are. Today was down 1.25%, which was significantly more than the spider, more than the NASDAQ, more than the IWM. And as the transports telling us that there's more downside coming that's imminent, and the other markets just haven't caught up on the downside yet, okay? We'll see if that happens, but that's certainly something to note. It's certainly one of the bigger puzzle pieces that I'm putting on the table. I'm watching it like a hawk. While we didn't close the day below the lows, so the low here, for example, is 7,075. The low here is 7,078. So 7,075 and change is the low. We closed at 7,086, but we did peak below it, making a low today of 7,058. So it's not an accident that we closed the day above the recent lows. However, it's a weak index, it's a weak market, and it's certainly indicating lower prices are coming. And if that's the case in the transports, you can expect sooner or later, most likely sooner, the other markets will follow suit. Staying with the theme of conflicting information, here's our broker-dealer index. Obviously a bearish pattern, a lot of overhead resistance, not going to get up above this level, above the moving averages so easy, but yet it wasn't a down day. It was at least a positive day, not by a lot, but it was up more earlier, but it still finished positive or close to flat, which was better than the major equity indexes. So it's just something to note. Bearish pattern anyway. I'm just suggesting that it's more conflicting information. And while we're on that topic, when we look over at the Philadelphia Semiconductor Index, you can see here that while nothing's changed from the larger picture, this is still a long bearish pattern. At least that's what it looks like on the daily chart. And I'll get to something else in a second. But we did get above and close above the moving averages today, which is interesting. So it's something that I want to notate, and I'm also putting it as one of the puzzle pieces on the table because the SOX definitely has the capability and does provide a leading indicator of the technology sector most of the time. So we definitely want to pay attention to it. But look at this. When you go to the weekly chart, there's something else that's very interesting. Now we have a pattern inside of a pattern essentially. However, the high of this red candle is 1099.41. The close of this green candle is above that level. So that takes the bearish pattern off the table. We still have this tail in place, so we can still go down. But inside of that, on a shorter term basis, look what happened. On the weekly basis, the 20-period moving average is holding the market. We tested it a couple of times. It's holding the market, and we have a bullish pattern. We have a large green up candle. We've pulled back, tested the bottom of that green candle, which comes in at around the 20-period moving average, and we're starting to move higher. So we have to note that. That's interesting. It's conflicting to a lot of other information that I'm looking at, but this is one of the reasons why it's a tough market right now to read from a lot of respects or a lot of points of view. So I just want to bring everything I'm looking at to the forefront. It's all going to shake out sooner or later, and in the end, we'll know what we can point back to and what we could have taken a cue from, and we'll certainly take a lesson, or we'll certainly take information that we're looking at now with all these different markets, and they'll become a learning experience. They'll become something that we'll take away, something we can learn from later and into the future. That's always the case. Each and every day in the market, at least I try and learn something every single day. Gold. Now, remember what we just looked at with the big tail candle in the SOX index. Now, that's interesting because what we have here is another tail candle, very similar, okay? And generally speaking, this would provide more downside off this tail candle in the gold market. However, gold is, it's holding up. It's in an uptrend. The moving average, at least the 20-period moving average, is sloping upward. It's not going down so fast. So the question is, what do we have? We have one of two things. We either have a tail candle, which is a down move, and we have a bearish pattern forming that will likely be another down move. That's certainly possible, happens more often than not. Or are we looking at a consolidation pattern? We have an up move, and we're just consolidating, and the market's going to ignore the tail candle. I don't know which one it is. I'm bringing both to the forefront. It's conflicting information, makes it very difficult to read. We get into these points in times where certain markets or the entire market is very difficult to read because there's no clear signal. There's no clear pattern that's telling us the highest probability scenario is X or Y. Sometimes we can look at the market and see two different things that conflict to each other, and the best thing to do when that happens is nothing with that particular market. Right now, the probabilities say that the tail candle will generally provide more downside than we've seen. However, we haven't seen it. Doesn't mean it's over. It's only 3 or 4 days removed. It can certainly go down from here, but something is holding this market up. And is it the fear trade of people accumulating gold because they think other people are accumulating gold because they're fearful that the stock market is going to come down or some other geopolitical event is going to shock the markets? That's certainly possible. Very difficult to read. Looking at the silver market, remember what we talked about last night. I said silver was more so in a bearish consolidation pattern underneath the 200-period moving average. That remains the case. We're seeing upward momentum today, certainly a little bit more than the gold market. Silver was up about 0.6%, gold was up 0.4%, but it seems to be, at least it looks like, silver wants to break to the upside. If it continues, it's going to bust through the 200 period moving average. We had two levels. Oh, we had one level on the upside. I have another level. The level we had was 1740. So we'll call it 1740, 1750. It may still provide a decent level of resistance, but I think that we've consolidated longer. If it breaks up now or in a couple of days from now, that we have a fair chance of getting up to the 1780 mark, which is this double top area here. That becomes, at least from my bird's eye view, the more likely next target on the upside for silver if we break above the 200 period moving average. Crude oil, a little bit of an update today in crude oil, up over 1%, not a bad day. However, we're still in the middle of a range. We had an up day, we had a down day. We had a narrow day, and then we have an up day. There's nothing really you can read out of this. We're essentially trapped in between the 20 and the 50 period moving average. Getting above the 20 or below the 50 will at least add some level of clarity. Until at a minimum, one of those two things happen, we're trapped and there's really not a lot we can do with the crude oil market. So we're in the middle of a range, we remain in the middle of a range, trapped in between the moving averages, not a lot we can do. We'll just move it along and take a look over at the bond market. Here we are again, approaching the upsloping trend line. Either this trend line is going to finally prove to be formidable resistance and reject the market for good and send the market lower, or we're going to beat on it long enough where we're actually going to bust through and go up to double top, and that would be this area here, up in this range at about 157.6. However, we can certainly continue to ride the trend line up to the point where we get to the double top, and that will be an interesting scenario if that takes place. It is formidable, the upsloping trend line. However, the more times we hit it on the upside, eventually they're going to break it down or break through to the upside. Can't be long looking for that to happen. And right now, if somebody were to be short the bond market, and whether or not you play the bond market doesn't matter, it's a chart that looks like this. So we're just going through a lesson in charting rather than just focused on the bond market. But right now, what you would really do if you were willing to take a short position, I would rather wait to see if we got to double top. It may or may not happen, but that would be the higher probability trade if we were to get to double top. Even if we had to ride this trend line for another several days, I would be more comfortable shorting the bond market at double top. It would be the higher probability trade. As the bond market continues to ride higher, yields continue to ride lower. When yields continue to ride lower, it's generally a sign of trouble in the equity markets. As I've said many, many times, the bond people, the bond market participants, are much, much smarter than the stock market participants. They generally will be ahead of the curve, and therefore it lines up with the cycle, meaning the equity cycle. It lines up with the cycle on the S&P that eventually we're going to see more downward pressure, downward activity, more of a corrective state or corrective action in the equity markets, and that certainly could mean higher bond prices, lower yields. That definitely makes sense. What we don't want to see, for the greater good, if you will, is we definitely don't want to see the stock market going down at the same time that the bond market goes down. And one day or 1 week doesn't really matter, and down not that much is no big deal. What I'm talking about is a 10 or 15% correction in the stock market. At the same time, you see a really big correction in the bond market in earnest, or a real downward pressure in the bond market. That tends to promote panic behavior. Eventually, we're likely to see something like that. I don't know that that's going to happen over the next month or two, but ultimately into the future, we'll see that again. We've seen it before. It will come again. That's when you see panic in the markets, where people don't know where to hide their money. Another down day for the dollar. We had a down day. We had an up day. We had a down day. The dollar is tricky. We're still inside this green candle until and unless we close below that. And if we do, we go see 88. will take a visit to 88 cents on the dollar. However, if this bullish pattern is going to play out, it's going to do it sometime soon. Otherwise, it's going to fail, and we're going to go down to 88. I'm watching it, but there's not much we can do with this at this point in time. And with that, I'm going to leave it there tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.